Hi, my name is Tom Prescott from Halifax Investments, and today I'll be covering Halifax's exclusive 2% financing offer on US and US listed stocks. That includes Australian shares that are also listed on the US Stock Exchange. I'll be explaining how the offer works, how you can qualify to take part in the offer, and what is the best strategy to use when trading this offer. Now, as always, please take a moment to read our disclaimer. With US interest rates at record lows, Halifax has been working hard over the past year to provide its clients with access to US rates. Now Halifax is allowing Australian clients to access US funding rates at only 2% interest for the purchase of US shares, as well as those shares that are listed on the US Stock Exchange that include most Australian large cap stocks, as well as the largest international shares. Halifax can only offer this to clients who have opened a Trader's Workstation account with Halifax Investments. Once done, investment funds need to be deposited to facilitate leverage trading on the platform. Now, this can take the form of cash deposits, or clients are also able to transfer existing shareholdings onto the platform, and they can be used to facilitate trading on that platform. For clients that have Trader Workstation balance investment funds over $100,000 US equivalent, then leverage available will be up to 10 times their investment funds. Below $100,000 US equivalent and above $25,000, clients are able to access up to 4 times leverage. The interest charged on these leverage positions will only be 2%. And one important point to make is that clients will only be charged interest on shareholdings that are in excess of their balances. For example, if a client has $100,000 worth of cash on their account and they leverage up to $150,000, they will only be charged 2% interest on $50,000. They will not be charged on the entire $150,000 position. Now, that's an important distinction because with CFD holdings, CFD interest is charged straight away at a much higher rate than 2%, I might add, on the entire holding once it's opened, regardless of what the client has invested in their account. This results in a large reduction in interest expense. Now, investors also have the option of keeping the funds deposited they have in either Australian dollars or US dollars, whatever is their preference. Keeping it in Australian dollars obviously reduces AUD currency risk. If clients wish, they are also able to keep their funds in US dollars. Trader Workstation account holders have access to the largest and most prominent companies in the world. Some of the shares you can purchase on the US market include Apple, ExxonMobil, Procter & Gamble, Caterpillar, Microsoft, John Deere, etc. You can also purchase Australian and international blue chip shares that are dual listed on the US market as well, such as Telstra, NAB, Woodside, BHP, Rio Tinto. For any clients that have margin accounts and they hold stocks such as Telstra, NAB, Woodside, etc., they're able to reduce their interest costs straight away by switching from holding Australian stock to US stock. So why are interest rates in the US so low? Well, over the past year or so, the US Federal Reserve has been implementing monetary policies designed to stimulate growth in the US economy. The aim of these policies is to reduce interest rates to as close to zero as possible, which allow US companies and financial institutions to access funds at very low levels. The main goal of this is to stimulate the economy, reduce unemployment, and improve the outlook for US companies. As a result of this, US companies have become very profitable. Now, the Federal Reserve aims to maintain these low interest rate policies up until the end of 2014 and most likely beyond. With continued weakness in the international economy and US unemployment rates remaining high, it's likely that these rates will continue to remain for some time to come. With US rates as low as they are, this also encourages investors to seek riskier investments, such as the share market, as opposed to putting their money in low-yielding bank deposits or government bonds. The flow of money into the share market has hence made the US share market one of the stronger performing markets around the world. Despite sluggish US economic growth, corporate earnings over the last 18 months have been strong, reflecting the effectiveness of low interest rate policies, as they have been able to refinance their debt at lower rates and become even more profitable. What is happening at the moment in the US is that the corporate sector, which over the past few years, when interest rates were higher, were issuing bonds at interest rates of 6, 7%, etc. They've now been able to refinance their balance sheet and issue bonds at close to 1%. As a result of this, these companies have become far more profitable. You can certainly understand that if you were able to, say, refinance your mortgage at an effective rate of close to 1%, your financial position would look much better. Now, let's have a look at the performance of the US market in comparison with the Australian market. Below is a chart of the US S&P 500 index, the top 500 stocks on the US stock exchange. That's in blue. And in red, we have the All Ordinaries index of Australia. You can see the US market has well and truly outperformed the Australian market. Well, we have access to US financing at 2%, but what is the best strategy to use when taking advantage of this offer? Well, at Halifax, we have developed a covered call strategy with put protection that enables clients to take part in a 2% financing offer with limited risk and improves their chances of success. Here we target high dividend paying stocks or strong growth stocks. The covered calls and high dividend yields enable us to improve our returns, but with the put protection, we ensure that our downside is limited. When you are trading stocks on margin, it is critical that you have some kind of protection in place to ensure that you do not lose too much money. The way that a covered call works is it requires purchasing a stock and then selling a call option over that stock. What you get out of it is a premium credited to your account for selling the call option. This is money that you keep, regardless of whatever happens throughout the course of that month. Now, if the person that bought the option from you elects to what's called exercise the call option, meaning buy the stock off you, then you are obliged to sell your stock to that person at the agreed upon price. Now, this is the case regardless of where the share price is. So if the stock has gone well above the option price, then you are still obliged to sell at the lower price. There are, of course, ways that we can get around having to sell our stock. You are able to roll the options and things like that, but I won't go into that now. So when you sell a call option, effectively you give up any upside on that stock above the strike price of that call. Now let's take a look at an example of how covered calls work. Let's have a look at the diagram below. Over here, you can see that we start off by buying 1,000 XYZ shares at $35. That's a total outlay of $35,000. Now, with XYZ trading at $35, we can sell a call for $36.50. Let's say this is for a 1 month period. Okay, so we sell an option with a strike price of $36.50, and for that we might receive 50 cents in premium. Now, because we have sold the call, what happens is that assuming we don't roll the option out and we get exercised at the end of the month, we miss out on any gain above $36.50. So our maximum profit for the month is $1.50, which is the difference between $36.50 and $35, plus the 50 cents in premium. If the stock stays below $36.50, well then we keep our shares and we also keep the 50 cents in premium that we have. Now that we have covered what a covered call is, we also implement puts on your portfolio to act as insurance against the falling stock price. Investors buy put options to protect the downside value of their portfolio. For example, if an investor is afraid that a stock they are holding might fall, but they do not want to sell that holding, they can purchase a put option. If the stock's price falls, the value of the option will rise, offsetting the price fall. To buy a put option, it will cost you a premium, like all insurance. We buy put options to protect your positions, and then we sell covered calls to offset the premium costs of the put protection, as well as to generate additional income for you. Now, let's take a look at an example of how put options work. Let's assume the stock XYZ is trading at $32. We can buy a 1 month $31 put option for 50 cents. Now, if at the end of the month, stock XYZ is trading at $31 or above, our put option is worthless. However, if at the end of the month, the stock XYZ falls to around about $30, then the option is worth $1. Difference between where the stock is trading and where we bought the put. Now, obviously, if the stock went to, say, 0, for example, then our profit on that would be $31, and we would have effectively turned 50 cents into $31. Of course, if you are holding this stock as well, then any gain from the put would be offset by the loss on the shares. But you can see how from this example, puts work as protection on our portfolios. One important point to make when investing in covered calls or put protection is that it is always cheaper to buy long dated calls or puts and sell short dated calls or puts. So what we do is we always buy long dated, sell short dated. Here is an example of Newcrest Mining call options. In this case, we're just looking at Newcrest Mining. However, this is the same for all stocks. Let's assume that it's the 1st of April and the price of Newcrest Mining is $29.50. All these calls here have a strike price of $30.50, so they're $1 away from where the current price is. Now, over here we have option prices ranging from April to August. The April call options are for 1 month, and it will cost you 54 cents to buy a $30.50 1-month call option on Newcrest Mining. If you were to buy one for May, then it'll cost you 98 cents. If you were to buy one for June, it would cost $1.30, July $1.60, and for August, which is a 5-month call option, then it would cost you $1.85. Now, the important point to make is that the longer that you hold the option for, meaning the longer the option has to run, the cheaper it is. Now, remember, with our put protection, we're buying that as insurance. So we want to get the cheapest insurance possible. That's why we would go and buy the longer dated put options, because on a per month basis, it is cheaper to do than buying the short dated ones. Now, remember, when we sell our calls, what we're looking at there is collecting as much money as possible. So for them, we only sell them out for 1 month. So for example, let's assume that we were doing this on Newcrest Mining, and the prices for the puts are the same as these calls. What we would do in this circumstance is we would buy the 5-month put option on Newcrest Mining, and that would cost us $1.85. So we'd be paying 37 cents per month for the insurance side of our strategy. However, we would be selling 1-month call options where we would be picking up 54 cents per month. So we'd be effectively paying less for our insurance than what we collect from selling the call options. And that's another part of our strategy that helps to improve returns for clients. Well, we've covered the first 2 components of our 2% portfolio strategy, the covered calls and long puts. The third component is what stocks do we buy in order to do all of this? Well, there are a number of criteria that we look at. Obviously, we want companies with strong growth prospects. We want companies that share prices are likely to rise. Another important factor is we have found some companies that have very high dividend yields. The US market provides us with opportunities to purchase stocks whose dividend yields are as high as 15%. Now, you can imagine that if you're getting financing at 2% and you're investing in companies that have dividend yields as high as 15%, then there is a lot of scope for gain there. What we do is, when it comes to stocks that pay high dividend yields, is we look to buy the stocks before they've announced upcoming dividends. So we're fairly certain that we're going to get those dividends. And we're constantly scanning the market for stocks with high yields, upcoming dividends, and more importantly, we want to know all the latest news on those companies' dividends. For example, what are the company's intentions to pay dividends in the following periods, etc. Here are just some examples of the dividend yields that you are able to get access to on the US market. We've got 4 companies here. ARMOR Residential Real Estate Investment Trust, which has a dividend yield of 17.5%. American Capital Agency Corp, 15.6%. American Capital Mortgage Investment Corp, 15%. France Telecom with 14%. We've been trading these companies over the past year and have been able to achieve great results as a result of that. ARMOR Residential Real Estate Investment Trust is a stock that we've been holding for a long time. Even though that company has paid out dividend yields that high, its share price has also remained relatively strong over that period. The same can be said for AGNC. Last time it paid out a dividend, the company's share price actually was able to hold despite paying out such a large amount. American Capital Mortgage Investment Corp has been another star performer for us, and France Telecom, that just recently paid out a dividend of $1 when the stock was only around about $13, and it carried most of its dividend the last time it paid it out. Now, here's our strategy in a nutshell. We identify stocks with either a high dividend payment coming up, or do we expect to have strong share price appreciation. We constantly monitor the prices of these stocks' puts, and we wait until we can get put protection at low cost. We simultaneously buy both the stocks and the puts. Remember, we buy long-dated puts that have between 4 to 8 months to run. This enables us to collect the maximum amount of dividends over that time, gives us the maximum amount of time for the trade to move in our favor, as well as ensures that we get the put protection at the lowest possible cost. We then look for around about 8 to 10% capital growth, and we write short-dated calls over those positions. Remember, by writing the short-dated calls, what we're doing is we're collecting extra return in comparison to the price that we pay for our puts. Now, as part of our risk management strategy, what we aim to do is only risk a maximum of 5% of the portfolio in any one trade. That means that, for example, if you have a $100,000 portfolio, our maximum risk per any one trade is only $5,000. Now, this includes the cost of the puts. As a result of this, the way our strategy works is that if we are able to get one trade right, that would offset a trade that goes bad for us, in keeping with our risk management strategy. Now, let's have a look at an example of a recent trade that we did. American Capital Agency Corp, AGNC, pays quarterly dividends. The company pays around about $1.25 per share. Its current share price at the time when we purchased this stock was around about $32. The next dividend payment was on the 21st of June 2012, so we bought the stock right before it went ex-dividend. At that time, we were able to buy put protection. We bought $28 January 2013 puts for $1.43. If we're looking at a $100,000 account, we would look to buy 900 AGNC shares at $32. So the maximum potential loss that we could possibly have on this trade is $4,887. That is the $1.43 that we paid for the put, plus the $4 difference between the $32 of where we bought the stock and the $28 of where we bought the January puts. If you multiply it by 900 shares, $4,887. Now, between the time of when we bought the shares and the time of when our January put expires, this company will pay 3 quarters worth of dividends. It'll pay one on the 21st of June, pay one for the next quarter, and then pay one for the following quarter. So in the time that we're holding this position, we'll collect $3.75 worth of dividends. If our maximum risk is $5.43, that $3.75 will greatly reduce that. So our maximum potential loss will drop to around about $1,500. There is, of course, depending on the financing, the 2% interest charge as well, which hasn't been brought in here. Now, our maximum loss in this situation is capped at only around about $1,500 plus the little bit that we have to pay for the financing costs. But what we're looking for is agency's share price to rise, and then we look to do covered calls over that stock. Now, if we're getting $3.75 in dividend payments, maximum loss $5.43, and over that time we write a few calls, then our maximum loss reduces substantially. And we're able to achieve significant gains on that if the share price moves up, or if we can get enough calls away over that period. So we have a maximum loss of around about $1,500, but we're looking to gain around about $5,000. And that's the type of trade that we look for. We look for a situation where the risk is relatively low because, for example, dividend yields is high, and with all the dividends coming in, it helps to offset the maximum loss that we can have on this trade. But we look to gain considerable capital gain by obviously doing the calls and also share price appreciation. If, for example, agency share price went up strongly, we could, for example, just close out that trade, sell the put, get our $1.43 back, or round about that price, and achieve a considerable capital growth over that period. Well, we have reached the end of our webinar. Here is a summary of what we have covered. With our 2% finance offer, We're taking advantage of record low interest rates in the US market to purchase shares which either have high yields and or strong growth prospects. The US market and US shares have been some of the best performers in the world. There are considerable tailwinds pushing up the US market, with the US Federal Reserve and other central banks around the world printing money to generate economic growth. With bond and deposit rates at record lows, money has to flow into the share market if investors want returns above inflation. On top of that, low borrowing costs are making US-listed companies more profitable than ever. Our covered call strategy with put protection ensures that there are strict risk management procedures in place, and before any trade is placed, our maximum loss is always defined. This provides investors with the best chance of achieving strong returns. Thank you for taking the time to tune into our webinar, and if you have any further questions, please do not hesitate to contact either myself on 03 9667 1904 or tom@halifaxonline.com.au, or my colleague Wilbur Mock on 03 9667 1919 or wilbur@halifaxonline.com.au. Thank you.